Informed consumers know that annuities offer maximum benefits and guarantees for those seeking retirement income solutions during good and bad economic conditions. Unfortunately, not all retirement income solutions using annuities are created equal. Some fall short of providing maximum benefits, leaving many consumers disappointed and frustrated. Hello and welcome. Today I want to explain an interest crediting option that insurance companies offer on certain annuity products. This interest crediting option is called indexing strategy and is available on fixed indexed annuities. So let's get started. Most of you are familiar with the major stock indices such as the S&P 500, the Dow Jones Industrial Average, NASDAQ 100, to name a few. Let's take a look at a hypothetical retirement plan spanning 25 years. Since we cannot see into the future, we will use historical data for the stock index. Let's use the S&P 500 as it is the most common stock index used for the indexing strategy option. Our hypothetical retirement plan will end on June 30th, 2012, when our investor, let's call him Investor A, retires at age 65. So we'll be using historical stock data going back 25 years for this particular presentation. Investor A is going to make contributions to his retirement plan in the amount of $10,000 annually. So it's $10,000 of annual contributions. Let's see how Investor A's plan works out. As you can see, as I scroll down, even though Investor A starts his retirement plan back in 1980, actually the start date for this investment is July 1st, 87. At the end of that first year, he starts off with a loss in the first year. The majority of investment years provide very good positive returns, with some negative returns sprinkled in. Overall, as we look at the summary, Investor A earned an annual rate of return of 5.37%. Keep in mind, this investor's entire retirement fund was at risk each and every year. But luck was on his side, and he is actually able to retire on June 30th, 2012, when the market was in an upslope. So he recovered from losses incurred in years 21 and 22. Now ask yourself these questions. Should I be depending on luck when investing for retirement? Will the market be in an upslope when I'm ready to retire? Let's answer these questions with another question. Could I invest in a major stock index like the S&P 500 but not expose my entire retirement fund to risk? Our second investor who has the same retirement plans, let's call him Investor B, is using the indexing strategy option we told you about. So let's turn that indexing strategy on. Ignore the input fields below for the time being. We'll get back to those. Let's scroll down and take a look. As you can see, indexing strategy keeps the peaks of positive returns but loses the valleys or negative returns. And looking as we move down to the summary details, if this was our dream retirement plan, we would have doubled the rate of return versus the actual stock index return. In other words, 10.58% rate of return annually versus 5.37%. What a retirement plan. So does index strategy actually exist, or is it a dream? Well, indexing strategy does exist, although it will not produce this dream retirement plan. Indexing strategy exists and there is a cost. In order to lose the values or negative returns, the insurance company holds onto some of the peaks or positive returns. Let's go to the input fields and see how this works. Insurance companies keep some of the positive returns by using either participation rates. 100% in this case means you keep all of the positive returns, which is what we have set it at, and which is really a dream if that actually existed. They also use caps by setting a cap, which is the most you will keep in positive years, or by using annual fees or spreads, and they basically, by deducting a percentage of the positive returns, they give you the balance. In a few instances, they also use combinations of these three different types of moving parts, as we call it, to come up with a net return to you. Finally, there are over a dozen indexing strategy types. We will continue, basically confine ourselves to the most common and easily understood type. To keep this tutorial simple, we will just use the participation rate and see how this affects investor B's returns. Let's assume that the insurance company keeps 70% of the positive returns, so investor B gets only 30%. As we scroll down, we see, as expected, there are no valleys or negative returns, but the investor only gets 30% of the gains in positive years. The end result is investor B earns just 3.18% to the 5.37% that investor A earned in the actual stock index. This doesn't seem like a good deal. The price of protecting B's retirement funds from risk seems too high. So let's go back and change the participation rate. We'll make it 50%. In other words, the insurance company keeps 50% and investor B gets to keep 50%. By the way, insurance companies can and did change these rates frequently over this 25-year period. In some instances, the participation rate was as high as 80%. In other words, the investor kept 80%. In the past 5 years or so, participation rates have been low, 25 to 40%. The 50% we're illustrating here is about the median for the entire 25-year period. Let's see the results. We'll scroll down, and as we see, the investor B now gets a 5.31% annual rate of return, virtually matching the return that investor A received on the actual stock index. Let's stop here and re-examine our objective. We did not want to depend on luck when investing for retirement, because we may not end up retiring when the market is in an upslope. So let's now look at what could happen if investor A over here was not so lucky. Let's step back in time year by year to see what happens to our investor if in fact we did not have an upslope in these last few years. So let's go simply by going back 1 year. So the end date is now June 2011. We basically see that it's still an upside market, so investor A has more in his account than investor B. But something is bothering investor A. He never quite recovered from the losses he experienced in years 22 and 23. After all, at the end of year 21, he had over $580,000, but is now retiring with about $556,000. Well, that's the market, so we won't worry. He's not going to worry too much about that. Let's go back another year to 2010. Again, an upside market by 1 year, but this time with significant losses in years 23 and 24. He is very upset at his inability to recover. So investor A is looking at really a situation where he has never really recovered from the bad years in years 23 and 24. Investor B, on the other hand, now has significantly more in his retirement account than investor A. Finally, 2009, even worse for investor A. So with a simple click of our mouse, as we've been doing, we can appreciate the significant swing that can occur if luck does not go our way. Peaks and valleys come with the stock market. If you want to benefit from the tremendous upside of the stock market, but protect yourself from the downside, then the indexing strategy option is a clear winner. Keep in mind that because the indexing strategy is inside an annuity, investor B also enjoys tax-deferred growth. For more information, visit our website at www.annuitydoubleFeature.com. Thank you and have a great day.